Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the wild world of corporate finance. And if anyone thought things were getting too quiet in the cannabis industry, well, buckle up, because Green Thumb Industries has a few surprises for us today. So Green Thumb Industries, usually known as GTI, is dropping a Form 8K, which is basically a way for companies to announce major events that shareholders need to know about right away. Now, this isn't their quarterly report, so we're not diving into tons of financial tables, but what we do have here is a pretty interesting set of deals that shed some light on their strategy and their relationships with certain companies, especially Agrify Corporation, and welcome back to that in their relationships with certain companies, especially Agrify Corporation. Okay, so the big news is that on August 27, 2025, Green Thumb sold a bunch of its intellectual property, its brand stuff essentially, to a company called Agrify. This IP includes some really well-known brands like Rector Bebo Dog Walkers, Dr. Solomon's and Shine, and Good Green. Think of these as the secret sauce for their products, the things that make customers choose them over others. Now for this sale, Green Thumb got $50 million in cash. This is a significant chunk of change, and it tells us a few things. First, GTI is monetizing some of its brand value, that means turning its popular names into actual cash, which can then be used for other business activities like expansion or paying down debt. Here's where it gets really interesting. Green Thumb already owned about 35% of Agrify Corporation. This means they were already invested in Agrify's success, and owning that much stock means they have a pretty big say in how Agrify operates. Plus, the CEO of Green Thumb, Benjamin Kovler, also happens to be the chairman and interim CEO of Agrify. This kind of overlap is not uncommon when companies are strategically aligned. So after selling the brand IP to Agrify, Green Thumb immediately signed a deal to license those brands back. This might sound a bit confusing, but it's actually pretty smart. Under this new agreement, Green Thumb subsidiary GTI Corp will pay Agrify a monthly fee to use these brands and recipes. They're essentially renting their own brands back from the company they just sold them to. This license fee is not a fixed amount. It's based on how much Green Thumb sells using those brands. This is a common arrangement where the licensor gets a cut of the licensee's sales. It ensures that Green Thumb continues to benefit from its popular brands, while Agrify gets a steady stream of revenue from the licensing deal. But wait, there's more. The same week, Green Thumb also loaned $45 million to Agrify. This loan comes in the form of a secured convertible note. This means Agrify borrowed money from Green Thumb and has the option to pay it back or convert it into shares of Agrify's stock. Green Thumb is essentially financing Agrify's operations or perhaps a specific project. This loan carries a 10% annual interest rate, which is a pretty good return for Green Thumb. They'll receive these interest payments twice a year. This means Green Thumb isn't just selling assets, it's also acting as a lender, becoming a financial partner to Agrify. Convertible notes often come with certain conditions or covenants. These are promises that Agrify has to keep, like making sure they have enough shares available if Green Thumb decides to convert the debt into stock. They also have to maintain the seniority of this debt, which means this loan has a priority claim on Agrify's assets if things go south. The really flashy part of this note is that Green Thumb can choose to convert it into Agrify stock. This means if Agrify does well and its stock price goes up, Green Thumb can turn its loan into a much larger stake in the company. There's a limit on how much stock they can own, though 49.99%. This is to avoid certain regulatory issues and to ensure Agrify doesn't become a wholly owned subsidiary of Green Thumb. Just from this one transaction, Fortify doesn't become a wholly owned subsidiary of Green Thumb, just from this one transaction. The conversion price is set at $29.475 to NASDAQ rules for minimum share prices. This is important because it sets the valuation at which Green Thumb can acquire more stock if they choose to convert their loan term. Now, let's step back and look at the bigger picture here. Why would Green Thumb do all this? First, it's a strategic move to raise capital by selling off valuable brand IP. This gives them immediate cash to reinvest or strengthen their balance sheet. Second, by licensing the brands back, they retain control and benefit from the ongoing success of these popular products. It's like selling a house, but getting to live in it as a renter paying rent. Third, by lending Agrify money and having the option to convert that debt into equity. Green Thumb is doubling down on Agrify. They're not just a shareholder, they're a secured lender and a potential future controlling shareholder. This signals confidence in Agrify's future and a desire to deepen that relationship. The CEO's dual role as head of both companies also suggests a very closely managed integration and shared vision. It's a bit of a Venezuelan combination of selling and buying, lending and investing all at once. From a financial perspective, Green Thumb got $50 million in cash from the sale. It's earning 10% interest on a $45 million loan, and it retains the upside potential if its investment in Agrify through conversion of the note proves profitable. The risks here are tied to Agrify's performance. If Agrify struggles, both the loan and the potential equity conversion could be less valuable. Also, the licensing agreement means Green Thumb is reliant on its own sales performance to pay those fees. Overall, Green Thumb Industries is showing a really proactive and well-capitalized strategy. They're not just a retail cannabis company, they're acting like a sophisticated investor and financier in the space. So what's my take on all this? Green Thumb is playing a long game. They're not just selling products, they're building an ecosystem. They are very effectively monetizing their intellectual property while simultaneously increasing their strategic influence and financial stake in a key partner company. This deal structure demonstrates agility and a deep understanding of how to leverage assets and relationships for maximum benefit. The move to sell IP and then license it back is a smart way to unlock cash without losing the core brand equity, and the convertible note to Agrify shows strong conviction in that company's future growth and a desire to be an even bigger player there. The main risk for Green Thumb definitely lies in Agrify's execution if Agrify falters the value of that note. And any potential conversion could evaporate quickly, however the 10% interest provides a cushion. Looking at the broader industry, this kind of strategic financial maneuvering by larger players like Green Thumb could be a trendsetter. It shows companies are looking for creative ways to fund growth and solidify strategic partnerships in a competitive and evolving market. Alright, that's our breakdown of Green Thumb Industries' latest moves. What's your take on these strategic maneuvers? And do you think this partnership with Agrify will pay off? Let us know your thoughts in the comments below. If you found this deep dive helpful, make sure to hit that like button and subscribe for more corporate breakdowns. We also have a growing community over on Discord, so check out the link in the description to join the conversation. Thanks for watching, and we'll see you on the next one.